Alright guys, housing market update time, and there is a lot that is happening right now that you need to know about whether you're trying to buy, sell, or just figure out where things are heading in general. Guys, home prices just hit a new all-time high for the month of May at a national median of $429,300. Mortgage rates are currently sitting at 6.7% after dipping slightly just this past week, and first-time home buyers are getting crushed harder than ever with 242 cities in America now having starter homes priced at $1 million or more. And so, with that being said, there is a lot to break down in this video, so I ask that you please stay with me all the way to the end of this video because I'm going to give you my honest take on what comes next. And that's for things like prices, for rates, and for what you should actually do if you're sitting on the fence about buying right now. So guys, let's not waste any time and let's jump right into it. Okay, so let's start with home prices because this is where most of the clickbait lives, and I just want to give you the straight truth. Nationally, home prices are up 1.3% year over year, according to the National Association of Realtors, with the median hitting at $429,300 just in this past month, which is an all-time high for the month of May. So, let me be completely clear going into this video. There is no housing market crash happening anytime soon. During the last real housing crash that started in 2008, the prices fell 28% at the national level. But now, they're just completely up. And unfortunately, those are two completely different realities. That said, the picture is not uniform across the entire country, though. More than half of the 20 major US housing markets recorded year-over-year price declines in March, reflecting a broadening and deepening housing slowdown in certain areas. For example, Florida had the hardest hits. Markets like Tampa, Orlando, and parts of Panhandle are seeing meaningful declines. California and Texas are also seeing softness in select markets. But on the flip side, 223 out of the 300 largest metros still have their prices going up. The Midwest continues to attract buyers looking for realistic price points. Places like Rockford, Illinois, or Rochester are seeing solid demand from young buyers who simply have been priced out of the coastal markets. The migration pattern I've been watching over the past few years is still playing out the same way as well. People are leaving California, New York, and Illinois, and they're heading to places like Florida, Arizona, and increasingly the Midwest. And guys, my honest one-line summary on prices, it's just not crashing, not surging, slowly grinding higher in most places, while a handful of overheated markets are starting to cool off. So now I'm going to talk about mortgage rates because this is the variable that is affecting everything else in the housing market right now. And understanding why rates moved the way that they did in 2026 actually tells you a lot about where they could go from here. People started this year with real optimism, including myself. Rates had dropped about a full percentage point in 2025, and the Fed had cut rates 3 times. So there was genuine hope that the path toward affordability was finally opening up. But of course, the conflict with Iran, surging oil prices, and a growing inflation rate in March, the trajectory noticeably changed. Energy prices drove inflation up, which drove Treasury yields up, which drove mortgage rates back up. But because mortgage rates follow the 10-year Treasury yield almost step for step, this is why you saw the change. Rates got as high as 6.75% before pulling back as the ceasefire between the US and Iran started to hold and oil prices began easing again. The 30-year fixed rate is sitting at 6.47% according to Freddie Mac, and this is down slightly from just last week's 6.52%. And between the beginning of January and the end of May, mortgage rates rose by close to 10% on average, and home buyers lost about $11,000 in buying power alone. Between February, when mortgage rates averaged about 6%, and April, when rates were around 6.3%, unfortunately, the rates have moved even higher since then. The key variable here going forward is still the Iran situation. If the ceasefire holds and oil normalizes, the rates will ease. But if things escalate again, the rates will, of course, go back up. Housing economists have largely stopped predicting rates fall below 6% anytime soon, which is a meaningful shift from what most of them were saying at the start of the year. Now, Now guys, real quick, if this video is giving you any value so far, please show some love by smashing that like button, leaving a comment down below, and subscribing. Your support genuinely helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's go ahead and move to the next segment. Okay, so now let's talk about the piece of this that honestly keeps me up at night when I think about younger people that are trying to get into housing. Because the affordability situation for the first-time buyers right now is genuinely alarming. There are now 242 cities in America where starter homes, defined as homes that are in the lowest 1/3 of prices in a given area, are priced at $1 million or more. I mean, that's literally the minimum. Just back in 2020, that number was 80 cities, not 242. But fast forward to last year, it was at 226. And again, this year it's 242, and that number is still climbing. California alone has 105 cities where the typical starter home costs $1 million. New Jersey went from 1 city before the pandemic to now 26 cities. And I just want you guys to think about that jump for a second. You see, the golden rule in personal finance is that you shouldn't spend more than 30% of your income on housing. The median salary for a young professional between 25 to 34 is about $59,000 a year. If you're trying to buy a $1 million home with 20% down at today's rates, you need to be making around $222,000 a year just to stay within that 30% rule. And then just put 5% down, and then that number jumps to $242,000 of a yearly salary that you would need to have. So you see, these numbers are simply not workable for the vast majority of people in those 242 cities. Nearly 70% of mortgage holders had interest rates below 5% at the start of 2026. And swapping that low rate loan for a new $400,000 loan at 6.5% would increase monthly payments by about $381, which is why so many existing homeowners are refusing to sell and give up their rate. And unfortunately, that lock-in effect keeps supply tight, which keeps prices from falling, which keeps first-time buyers locked out. Yeah, guys, it's genuinely a difficult loop to break without either prices falling or wages rising significantly. And right now, neither of those things is happening fast enough. Okay, so with that being said, now let's talk about supply, because supply and demand is ultimately the only thing that actually determines where home prices go. And the supply picture right now is mixed in a way that explains why prices aren't crashing, even though affordability is absolutely terrible. Active listings are up about 1.8% year over year, and new listings are up about 2.1%, which is better than it's been in the last few years. Home sales actually rose to 3.2% to a 5-month high just in May, with first-time buyers making up 35% of those purchases. So guys, based on me looking at the data, there is some movement happening. But again, here's the problem. The supply increase is not nearly enough to move the needle on prices in any meaningful way. We need a flood of new inventory to push prices down. And that flood is not coming anytime soon. The biggest reason, again, is that lock-in effect that I mentioned earlier. Nearly 70% of mortgage holders started 2026 with rates below 5%, which means millions of homeowners are essentially trapped in their current homes because selling means up giving a rate that they will never see again and taking on a mortgage at 6.5%. Now, maybe I shouldn't say never see again, but likely not to be seen soon. Now, until rates come down significantly or people face a life event that forces them to sell, those homes are not coming to market. And there's also something else that's worth knowing. An outdated capital gains tax rule from 1997 may be discouraging 13 million homeowners from selling their homes because home values have risen so dramatically since then that many homeowners would face huge tax bills on their gains. And all of that adds up to a market where supply is technically improving, but not fast enough to offset demand or meaningfully change price direction. All right, so now let's bring all of this home. What does all of this actually mean for your decision making right now? Guys, if you are a buyer, here's my honest take. Don't wait for a crash that the data does not support. Home prices are not crashing nationally. The supply is not surging either. And if anything, the moment the rates do come down, demand is going to rush back in, and whatever affordability relief came from slower price growth could evaporate quickly. That said, what I recommend is that you be aggressive about your offer strategy right now because the buyer pool is thinner than it's been in years, and sellers who are serious about moving are more negotiable than they were in 2021 or 2022. 25% of homes are still selling above list price. So deals do exist. They just take time and they take patience. I recommend that you shop your loan aggressively because even a small difference in your rate can save you thousands of dollars over the life of the loan. And if you're a seller and you're serious about moving, price your property aggressively from day one. The longer a home sits, the more leverage you lose. Buyers start wondering what's wrong with your property, and your negotiating position weakens every week that it sits on the market. If you're on the fence and you genuinely cannot afford to buy right now without stretching dangerously beyond the 30% rule, especially in one of those 242 cities with $1 million starter homes, then renting and aggressively saving while watching this market is probably the smarter move. Unless, of course, you're able to be young again and move in with your parents. And guys, the single most important thing to watch going forward is the Iran situation and what happens with oil prices, because that is the direct line to inflation expectations, treasury yields, and ultimately mortgage rates. If the ceasefire holds and oil normalizes, we could see rates ease back towards 6% or below by year end. If, of course, it falls apart, then I would say all bets are off. Guys, I want to thank you for watching this video all the way through. Please subscribe so you don't miss the next update that I tend to put out every other day. Also, please drop a comment down below and tell me what market you're in and what you're seeing locally. I genuinely love hearing from all of you, and I do respond to every single comment. So guys, thank you again for watching this video all the way through. I'll see you guys in the next video.